When people hear the word stocks, they usually think of charts, numbers, or something complicated. But in reality, a stock is one of the simplest concepts in finance. A stock is just a small piece of a company. When you buy a stock, you're literally buying ownership of a real business, even if it's just a tiny little percentage. Think about a company like Apple. It's not just a name on your phone. It's a business that sells products, generates revenue, pays employees, and makes profit. Now, instead of just one person owning the entire company, ownership is divided into millions or even billions of pieces. Each of those pieces is called a share. So when you buy one share of Apple, you are owning a small fraction of that company. That means that if Apple grows and becomes more valuable, your piece of it becomes more valuable as well. But here's where most people misunderstand things. The price of a stock doesn't just move because a company is good or bad. It moves based on what people believe the company will be like in the future. The market is constantly trying to price its expectations. So when investors think a company will grow faster, earn more money, or dominate its industry, they start to buy. And when more people buy than sell, price goes up. When people lose confidence or think growth will slow down, they start to sell, and then price goes down. For example, imagine Apple is currently trading at $250. If investors expect strong iPhone sales, new products, and increasing profits, they may be willing to pay $260 or $270 for that same share because they believe it will be worth more in the future. That demand pushes the price higher. But if Apple reports disappointing earnings or signals slower growth, investors might decide that $250 is too expensive. And they start selling. Now the price drops to $240 or lower. The company didn't change overnight. What changed was people's expectations. This is why sometimes you'll see something that doesn't make sense at first. A company can report good results. Maybe they even made more money than the last quarter, but the stock still drops. Why? Because the market was expecting even better results. So even though the company did well, it didn't meet expectations. And in markets, expectations matter just as much, if not more, than reality. Another important thing to understand is that stock prices are driven by supply and demand in real time. Every second, buyers and sellers are placing orders. If more people are aggressively buying, price moves up. If more people are aggressively selling, price moves down. This is happening continuously, and that's what creates the movement you see on the charts. So when you look at a stock chart, you're not looking at random lines. You're looking at the result of thousands or even millions of decisions being made by traders, investors, institutions, and algorithms. Now let's bring this back to you, the trader. When you buy a stock, you are making a decision that the price will go higher from where it is now. You're not just buying the company. You're buying it at a specific price because you believe someone else will be willing to pay more for it later. And if that happens, you profit from the difference. If you buy at $250 and the price goes to $260, you've made $10 per share. If it drops to $240, you lost $10 per share. Same company, same stock, the only difference is timing and price. This is why trading and investing, although related, are not exactly the same thing. An investor might buy Apple and hold it for years because they believe in the long-term growth of the company. A trader, on the other hand, is focused on shorter-term movements. They might buy Apple today and sell it tomorrow, maybe even next week, or within minutes, depending on how price moves. The goal is not to own the company forever, but to take advantage of the price changes. Another layer to this that most beginners don't realize is how much psychology plays a role. Markets are driven by human behavior. When people are optimistic, they buy more aggressively. When they're fearful, they sell. When everyone believes the stock will go higher, it often already has, because everyone has already bought. And when everyone is scared and selling, that's often when opportunities start appearing. So stocks are not just about companies. They're about perception, sentiment, and timing. You'll also hear people talk about things like earnings, news, interest rates, and economic data. These are all factors that influence how people feel about a company's future. For example, if interest rates rise, borrowing becomes more expensive, which can slow down business growth. That can make investors less willing to pay high prices for stocks. Or, if a company announces a breakthrough product, investors may be more optimistic and push a price higher. Again, it comes back to expectations and how those expectations change. So if you're going to take away one thing from this video, it should be this. A stock is not just a chart or a ticker symbol. It is a piece of real business, and its price is constantly changing based on what people believe that business is worth. Not just today, but in the future. Once you understand that, the market stops feeling random. You start to see that every move has a reason, even if it's not always obvious at first. So now you know what a stock is. And in the next video, I'm going to explain something more dynamic: currencies. We'll break down how Forex actually works, and how currency pairs like the Euro USD actually move. And finally, how global economy directly affects price. Because once you understand that, you'll see how everything in the market is connected. I'll see you in the next one.